Luke, thank you for joining us. There's actually quite a lot of good stuff as well, especially when you look at the alternatives. But we need to start with the share price down some 7.2%. What are investors looking at today?
I think CEOs should never complain about what the market does with their share price. And given we make our money out of the fact markets are inefficient, I'm not going to get bothered. I mean, in the statement, I made what sounds a cautious comment about what's going on in markets, because I think markets are, clearly markets have been very volatile in the first half. Clients don't know what's going to happen in the second half, and institutional clients are trying to work out what to do. Anybody who thinks they can predict, you have to predict what's going to happen with inflation, what's going to happen with the Fed, to then get to what happens to markets, to then get to what clients may do in the second half.
But what do you think? So the underlying issues that what clients could, or inflow, are you worried about inflows because clients will get the market chaos and say, actually, I'm not sure this is the right time to go in?
No. So look, we had good inflows in the first half. In what we do, we outperformed by about 2.7% in flow terms, right? So we had inflows over the first half. What you saw coming into, sort of started about in mid-May, that a number of clients started to recognize that they were going to have margin calls on the hedging that they'd done. Imagine you're a euro-based investor, you've got 50% of your assets outside, probably in dollars. And if you've hedged that back, your margin call is going to be 5–10% of the overall plan. They had an urgent need to realize cash. Clients are sitting there trying to think, okay, we've had this big volatility. What does it mean for the future? We see it's very clear you're going to get lots of demand for liquid alternatives. So the inflow side of the equation looks very strong through the second half of the year. But what are clients going to do about their overall portfolio? I think anybody who would say they know is guessing, basically. And I just said, look, we think clients are trying to work out what to do. It will depend.
What do you think they'll do?
So I think personally that I think the big picture is we've got inflation. It's got into wages. I think that leads to years, not weeks, of economic volatility. It doesn't mean rates are going to go up to N, but in the end, the only way you get rid of inflation once it's into wages is to cause a recession that causes unemployment. The question is, will central banks do it this time or next time or next time? That creates economic volatility. For liquid alternatives, that's both very good for generating performance fees and also for flows looking forward, because if you've got a volatile world, sitting just long concentrated equities is not the right answer.
So you're not expecting, is it even possible at this point for the Fed to engineer a soft landing?
It's possible that fairies exist, but it's pretty unlikely.
Is there a type of client that is attracted to hedge funds because of the market chaos?
I mean, yes. Look, we saw very good inflows into our alternatives in the first half of the year, and I'm very confident that will keep happening. And sort of every client is attracted to it, right? I mean, in the end, in our alternative products, we made very good returns in the first half of the year. In all of AHL's flagships, they're up, more than 10%. That in a market chaos is pretty remarkable, right? And the sort of, even anyway, they shouldn't get into individual funds, but they make money in the times of difficulty. Hedge funds have delivered in the first half of the year, and good hedge funds have delivered really well. That is clearly attractive for the clients who think the turmoil in markets will carry on.
Yeah. How long do you think the market turmoil will carry on? I mean, you were talking about a matter of years.
Yeah, right? Personally, yes. I think it's more likely that it's a matter of years than a matter of weeks. So that doesn't mean that we will go down in a straight line over that period, not at all. And one of the things when you look through these inflation-driven periods in history, remember, one of the things is Mr. Market is made up of, on average, a 40-year-old, and they've never seen inflation. You have to go back to the 70s, you have to go back to earlier periods to get real inflation and see what happened. And it's possible that central banks really have it in them to do the things it would take to get rid of inflation now. The trouble is, it takes a significant recession, and I don't see central banks really being driven to cause that. If they don't, then inflation maybe it'll get down to 3.5–4% next year.
But you're talking about Mr. Market, but it seems Mr. or Mrs. Central Bank also hasn't seen this coming, right? Inflation. Are we reaching the end of monetary policy, of what it can achieve? And is this actually the new normal for trading in markets and for hedge funds?
Monetary policy has never been able to get rid of market or of economic cycles. That's just never been a thing, right? And they did a lot to dampen, but every time over the last 20 years, they used up more and more of their tools to dampen things down. Because central banks, maybe if they'd acted very quickly and aggressively when the inflation started, when it was transitory because it was supply shock driven, maybe if they'd acted very quickly then, they might have got rid of inflation, but they didn't. It's now into the system, it's into wages, and once it's into wages, I'm afraid history tells you there's only one way to get rid of it.
How worried are you about euro levels, given the proximity to Russia and we saw parity?
Look, I think the European economy is in a very difficult position, right? We have basically double-digit inflation and give or take nothing in real growth in Europe. That's a pretty difficult place for a central bank. They have rates at zero. I mean, they're stuck with very difficult choices. And what's going on in Ukraine is horrible. But if you look at it from a rational set of decisions for Putin, it is entirely rational that unless Europe backs down, he's going to turn off the gas pipeline when it really matters. What he's doing at the moment is making sure we can't get stores of gas built up. And if he turns the gas pipeline off in November, the German economy is in a real mess.
Look, I mean, given all of this environment, so taking a step back, is there anything that you'd want to buy? Is it a good environment to buy another manager?
I don't know if what you said about the share price is true. Well, I'm pleased to say we'll do more of our buyback because it's a great opportunity. The bit, sorry, to go back to the results, our earnings were up 28%. Earnings per share in the first half of the year. I don't see anybody else in the asset management industry who's got results like that. We generated very strong performance fees in the first half, and I'm confident we can keep doing it.